Hi, I'm Rick Kahler. Thanks for joining me. I heard this recently. One thing I definitely don't want in my portfolio is bonds. A prospective client told me that just a few weeks ago. She went on to say, bonds are boring. They don't give good returns. Her confidence in her money script that bonds had no place in her portfolio was pretty palpable. However, her understanding of the role that bonds play in a portfolio was incomplete. I restrained myself from launching into a lecture on the importance of bonds and simply replied, well, it's true that bonds can be boring, but sometimes they can be phenomenally exciting. Certainly stocks and commodities, real estate investments are generally much more exciting. They are many times more volatile than bonds. In just a year, it's possible that they might even gain or decline 50% in value. Meanwhile, individually held bonds and their mutual fund counterparts can crank out predictable coupon yields quarter after quarter after quarter with 1/3 of the volatility of stocks. The cost of the lower volatility is that the long-term returns on bonds tend to be half to a third that of stocks. However, the bond market right now, it's anything but boring. So far this year, while stocks are back to prices roughly where they were in early 2018, a sharp fall in interest rate has caused bond investors to reap some significant capital gains. Bonds have an inverse relationship with interest rates, so the value of most bonds increase when interest rates decline, and the value of bonds goes down when interest rates go up, kind of like a teeter-totter. So how significant are the gains in bonds this year? Well, since the beginning of 2019, investors in the 30-year Treasury bond have seen gains, which is interest plus price appreciation, of 26.4%. I mean, that would be an outstanding full-year return for stocks. According to Bloomberg Barclays U.S. Aggregate Bond Index, long-term bonds overall have generated a 23.5% return this year. Investment-grade corporates have done 14.1%, while the 10-year Treasury note has done 12.6%. Market observers have predicted for the last decade or so that bond rates have nowhere to go but up. What we're seeing currently is a yield on the 10-year Treasury note of just under 1.5%. At the end of 2018, it was more than 3%. So obviously, they've gone down recently, significantly. Will we see more of the same? Well, it's hard to imagine that same 10-year Treasury bond falling another 1.5% to zero yield. So the smart money says that most of the gains have already been taken, and anybody looking for a 20% plus return in long bonds going forward is just chasing after the fact when the returns are dropping. But how smart is smart? Just in case you agree and think interest rates have nowhere to go but up, consider that many countries in Europe actually have negative interest rates. That's where investor or depositors are paying to loan their money to organizations or banks. So another 1.5% fall to 0% interest rates could deliver a similar 20% plus bond return. So the lesson here is that even if you think of bonds as the boring part of your portfolio, there are times when they can add a little more kick to your returns than you might have expected. And in times of falling equity markets, they're an invaluable buffer against really big losses. Still, with the long-term probability that bonds produce a return half that of equities, there's a significant chance that they're not going to sustain a 20% plus return as rates stabilize and increase at some point in the future, and could actually see losses for a year or so. Unlike the misinformed prospect I visited with, most investors over the age of 40 can benefit by having a substantial slice of their investment portfolio in bonds. Whether their returns are typically boring or occasionally exciting, bonds are an important asset class for diversified investors. Thanks for joining me.